Good morning and welcome to Thursday morning's market wrap. I'm Greg McKenna and it's been a very interesting night overnight. The Dow Jones, the Nasdaq and the S&P all opened on their highs but then steadily sold off across the day. That was in contrast to strength that we saw in Asia yesterday, where the Nikkei jumped 7.71% for an amazing rally in Shanghai, in Hong Kong and in the Australian market. That's put pressure on futures, and it's looking like the Aussie market in particular and the other markets of Asia are going to open lower. What drove that is difficult. There was a JOLT survey out last night, which is the job openings and labour turnover report, and that's an indicator that Janet Yellen looks like. But it came out after the market had already hit its high. So we saw that, that the US stock markets were already under pressure. What I think was going on, interestingly, is that we had a simple test of technical resistance in what is a wedge on the S&P 500, and then the market reversed off that, and we ended up with a sell-off and the market down 1% or so. If I just, I'll just share the chart with you, blow it up a little bit. Let me just do that. Sorry about this. You can see quite nicely that where is it? There we go. So whether this is the S&P or the Dow's in a wedge, the S&P's in this bearish pattern. So you can see here, nice top, exactly where the last top was. We've still got this bottom. We're wedging into resolution. There's no guarantee it's going to go down, although most people would probably tell you that this kind of chart pattern is bearish. But that's what's going on at the moment. Why is it going on? You might say, oh, I don't believe in technicals and that kind of stuff. And some people say, well, I don't like trend lines and those sorts of things. I believe what Keynes said back in the 20s or the 30s when he talked about markets being a bit of a beauty contest. And it's not necessarily who's the prettiest. It's the one who other people think is the prettiest. What he was saying was that you need to know what other people are looking at so you can know what their decision rules or their drivers are going to be. That's the main reason why I look at trend lines. And what we saw in the Dow last night and in the Aussie ASX market yesterday was pretty much a touch of the target, a rejection and a reversal. It's just the market trying to figure out whether it wants to go lower again or it wants to go higher. But for the day today, the ASX and Asia markets are going to start under pressure. In Australia at 11:30, we've got the jobs data. Unemployment is expected to fall a little to 6.2%, but employment's only expected to rise 5,000. Labour data in Australia is one of the most volatile and revisable economic statistics that are released each month. I stopped trading the outcome, so I stopped punting the outcome, if I can put it that way. So taking a position into it because I think I know what the number's going to be more than 20 years ago because it is such a volatile market. That doesn't mean if I'm long or I'm short and have been because that's what my system says that I necessarily exit before the labour data, but I don't punt on an outcome because it is so volatile. So with the market only expecting 5,000 today, there's a real chance, given that employment it has been rising so strongly recently, there's a chance that we could end up with a negative number, which would be the first one in ages. Equally, though, because of the volatility, volatility has two sides, two hands. We could get a higher number. So when we see that number, though, I'm pretty sure the Aussie market's going to react. Yesterday afternoon, we saw that the Aussie dollar broke down through the little hourly uptrend that it's been in for, or was in the early part of this week, and which gave us that rally up to the highs yesterday. You can see this nice little trend here that went through yesterday, and as it broke down, it then has tanked this morning. The reason it's tanked this morning, if you're not aware, and I'm sure most of you are, is that the RBNZ cut rates by 25 basis points. The Kiwi's been absolutely hammered. It's down in the order of 1.72% now at 62.75. If it can hold this 62 figure 30-34 level, it's probably going to bottom again. But that's the recent lows. If it was to fall through those levels, Kiwi could probably get hammered once more from traders who think that it's a shot duck But anyway, so that's been the excitement so far. Last night, the Bank of Canada left rates on hold and didn't really show any inclination that they wanted to ease rates any further just yet. Having said that, though, the Canadian dollar's back up towards 133. Every time I try and sell that, it goes nowhere. I haven't been stopped out yet. It's been a position I've had for a few days, or a week, I guess. So it's almost time to kill that one. But for the moment, I haven't been stopped out by price at all. So if we have a think about what's going on, gold's down again at 107. Oil got smashed again. I think if you look at your oil charts, have a look at the big, sort of 10-year or so chart of the monthly oil. Have a look at what happened when we had that breakdown of the big uptrend. It plummeted, it rallied, it retested, and then it plummeted again. That, I think, is the roadmap a lot of traders are using for some of the asset prices that had a similar setup. So, overall, my take is that the market is still bearish and that the rallies we've seen are opportunistic rallies within an overall risk-averse environment. Now, of course, that could change because all we need to do next week is the Fed to either go one and done, so one hike to get it out of the way, and then say we're in no rush. I personally think that would be a better result than no hike at all. But Larry Summers joined Joe Stiglitz, the IMF, the World Bank, in saying that the Fed should hold fire next week. But the thing is, with unemployment down at 5.1% and the US economy doing relatively well, and sure, it's not in the pink of health, it's not 4% growth rates and inflation at 2.5 or 3%, but realistically, the Fed needs to start increasing interest rates because where the market is, where rates are, is incompatible with where the US growth rate is. Now, of course, the counter argument is what's the rush? And of course, there's no rush. We've had QE of multiple stripes for 6 years or so. So whether they go now or December or even January early next year, doesn't really matter. But the question, of course, I ask is, the longer you wait, the more you build in the tension that's going to have to be worked through when ultimately the Fed does lift off, and that's the risk for markets. If we have a look at what's coming up tonight, we have obviously we've got employment here in Australia today. We've got jobless claims in the States tonight. In China today, we get CPI and money supply. That's going to be important. I think people will be watching that closely. We're also got a Bank of England MPC meeting. Now, obviously, sterling traders are thinking that we might get some sort of hawkish indication or something like that. Not really sure on that one, but sterling's been doing well, so it's probably a little at risk if the Bank of England doesn't deliver. And everybody will be watching the Bank of England closely to see what they say and how they word it as an indication of what the Fed might do next week, given the volatility that we're seeing at the moment. So it's going to be an interesting night, an interesting day. Stocks to probably open down lower, then to be influenced by whatever happens at 11:30 with Australian unemployment. The Aussie market sitting at 69, 74, 75, 76, sitting at the 61.8% retracement of the rally from early Monday. And so, I'll fall through there and you could get it back down towards the low 63s. Employment data is going to be the key driver for the Aussie day. So it's a data-driven day, which means it's a fractious day and a dangerous day if you're a short-term trader. So just be careful out there. As I always say, keep your position sizes and your volatility in your account relative to what's going on in the market. That's the safest way to do it. That's why I always do it. So that's it from me today. I'll be back tomorrow morning on Friday. So have a great day and bye for now.